Let me tell you a tale of a king who had a deep love for the game of chess. Whenever a wise traveler ventured into his kingdom, the king would extend an invitation for a game of chess. If the traveler emerged victorious, the king would generously reward them with something of value. One day, a visitor arrived in the guise of a saint, who was, in fact, Lord Krishna in disguise. The king, unaware of the saint's true identity, invited him to engage in a game of chess. As fate would have it, the king lost the match. Following their wager, the saint, in a humble manner, requested a rather unusual reward: a few grains of rice. Specifically, he asked for 1 grain on the first square of the chessboard, 2 grains in the second square, 4 grains in the third square, and so forth, doubling the number of grains with each subsequent square until they reached the 64th square. Initially, the king found this request amusing and readily agreed. However, as the numbers grew exponentially, he soon realized that fulfilling the saint's request would deplete the entire rice supply of the kingdom long before reaching the 64th square. It was then that Lord Krishna revealed his true identity and assured the king that he did not need to fulfill the request immediately. With time, this seemingly impossible task could indeed be accomplished. The story serves as a powerful illustration of the concept of exponential growth and the incredible potential of compounding. It imparts a valuable lesson about the remarkable outcomes that can be achieved through gradual and consistent growth over time. In simpler terms, compound interest means that you not only earn interest on your initial investment, but also on the interest that accumulates over time. This process can significantly grow your money. For instance, let's say you invest ₹100 in a mutual fund, and you earn a 10% interest in the first year, making your total ₹110. Now, in the second year, you earn 10% on 110 rupees, bringing it to ₹121. Similarly, in the third year, you earn 10% interest on ₹121, making it ₹133. As you can observe, while you earned only ₹10 in interest in the first year, you earned 13 in the third year. If you continue this process over the next 40 years, you could accumulate ₹4,500. This illustrates the remarkable power of compounding. The 15-15-15 rule in mutual funds works like this. If an investor invests 15,000 rupees per month for 15 years and receives a 15% annual return, they could potentially accumulate ₹15 crores at the end of the investment period. This might seem like a magical proposition, and indeed, it highlights the incredible potential of compound interest. But does compound interest work the same way in reality? The answer would be both yes and no. I said no because in the short term, the returns on your mutual fund may look somewhat different. However, I said yes because in the long term, the results are quite impressive and resemble the same pattern. A good mutual fund with the assistance of compound interest can provide returns of 10% to 20% in the long run. Let's consider the Nifty 50 mutual fund as an example. When it was introduced in 2000, it experienced a rocky start, delivering negative returns of 55% and 16% in its first and second years, respectively. For the average investor, this could be quite unsettling. In 2006, Nifty 50 made a significant comeback with a positive return of 35%. But it faced another setback in 2007 with a negative return of 50%. However, when we examine the overall return on investment over the following 20 years, Nifty 50 averaged an impressive 12% annual return. While Nifty 50 might be an extreme case, mutual funds in general exhibit much less volatility. The key takeaway here is that despite short-term fluctuations, mutual funds tend to offer a good, relatively low-risk return. These examples convey an important lesson. We should have faith in our mutual funds for the long haul and not be overly swayed by the market's periodic fluctuations. Reacting excessively to short-term ups and downs may not be beneficial. Those who exercise patience are more likely to reap the full rewards provided by mutual funds. In rare instances, the shadow of negative compounding interest can cast a pall over your mutual funds. To prevent such situations, it's crucial to be cautious about selecting mutual funds with higher risk profiles. The same power of compounding that can propel your investments to great heights can also lead to a swift decline. For instance, let's say you invested Rs 10,000 in a high-risk mutual fund, and in the first year it generated a 25% return, followed by another 25% in the second year, resulting in your investment growing to Rs 15,625 in just 2 years. However, if in the subsequent year the same mutual fund yields a negative return of 50%, your investment would plummet to Rs 7,812, resulting in a negative return of approximately 24% over 3 years. This example emphasizes the importance of not relying solely on past performance when making investment decisions. There are several other factors to consider when evaluating mutual funds, which I will delve into in upcoming episodes.